It may surprise you, but a mutual fund and an ETF that follow the same index could have different returns. And the more years that we're talking about, the larger the difference in returns. Hi everyone, I'm Andrew Marshall. Today I want to talk to you about why you should move out of mutual funds and into ETFs. In the long term, it's going to create more portfolio value for you. Let's get into it.
Reason number one is mutual funds have a cash drag. At the end of the day, they calculate the net asset value of all the holdings within the mutual fund, and the manager has to keep some cash on the side in case someone who owns shares wants to redeem their shares and ask for their money back. If it's not 100% invested, that's a drag on performance, especially when the market is going up and the stock market is going up most of the time.
The way a mutual fund works is if the manager sells shares in a stock and there are gains, those capital gains are passed on to each and every shareholder. So this may have happened to you like at tax time. You get your tax documents and you see you have all these capital gains and you're thinking, where's this from? I didn't sell any shares. Well, it's because you own a mutual fund and the manager of that fund sold shares, and so those capital gains were passed on to you. This doesn't happen in an ETF. The way an ETF works, they have an in-kind redemption process where they can switch shares around. Sounds kind of iffy, but they can shift shares around and not actually pass on the capital gains to the shareholders. So an ETF is much more tax efficient. Another surprise is there are actually expense ratio differences between mutual funds and ETFs. And the ETF generally is cheaper. We know that share expenses over time, they add up. It's taken away from your return. So owning the cheaper version is more helpful and will increase your portfolio value more. Shown here, the Vanguard 500 Index Mutual Fund, 0.04% per year. The exact same index in the ETF, 0.03% per year. It's not a big difference, but after 20 years or more, it is a difference. It's kind of surprising that there is this difference, but ETFs generally are cheaper than mutual funds. These returns were calculated by ChatGPT. A $100,000 initial investment in an ETF 20 years later had $408,000. Mutual fund following the same index had a value of $399,000, which is a difference of $9,380 after 20 years. That doesn't sound like much, but if you had a $1 million portfolio, that's $93,000 difference just from using ETFs. These results are showing us actual dollar amounts of reasons why you should move out of mutual funds and into ETFs. There's no difference in the investments at all here. These are the exact same investments. It's just the ETFs are so much more efficient that over time it makes a difference. In conclusion, I think it's worth it to move out of mutual funds and into ETFs. This is really easy to do in an IRA because there are no tax consequences of selling the mutual fund. It's not so easy in a brokerage account, but maybe you could do it over time. The reasons ETFs are better is generally they have lower expenses, they don't have a cash drag, and they're more tax efficient. For all those reasons, you should consider moving your investments to ETFs. Thanks for watching. I hope you enjoyed it. Please consider subscribing.